Hello everyone, it's InvestorZilla here, and I'm super excited to talk to you about cash covered puts. Now there are several ways to think about cash covered puts, but this one's going to focus purely on stocks that you like and you would not mind owning. Now if there's one thing I like more than cash covered puts, it's seeing the like button hit. Each time that number ticks up, it brings me just a teeny bit of joy. Take a second, let me know what you think. Hit that comment section. All right, let's get going. I like to think of cash cover puts as the series of steps. The first step is to simply find a stock you like, followed by step two, where you make sure that stock fits your investment profile. Meaning, if you end up owning the stock, you'll hold it for a long run. And you can check out some of my deep due diligence videos to understand kind of how I look at stocks and what kind of stocks I look for. The third step is to pick a price and determine how long you're willing to wait for that price to be hit. The fourth step is just double check to make sure there is decent option liquidity. You do not want to get burned not being able to close a position that you really want to close. The fifth is opening the contract, which leads to really two major outcomes. One is the stock drops to your buy price and you are assigned the shares. The second outcome is the stock never hits your buy target and you walk away with just the premium. All right, let's take it a little bit deeper. Here are a few real examples I pulled from my Robinhood account. Back in February, when AMC was close to $6, I decided I wanted to own the shares, but I was really looking for closer to $5, so I sold a cash covered put for 63 cents a share and waited. In this case, the stock went up, and it went up a lot. Uh, so I let the contract expire and kept my $63. The second example, again, AMC. This time I decided to be willing to pay a little bit more for it. After reading some of the reports coming out, I started to feel more comfortable even opening the position up at $8.50. So I sold a contract for $1.68, netted $168. What's cool is that if I did get assigned shares, I'm actually paying $8.50 minus $1.68. And if I really wanted to, I could count that 63 cents a share that I had in the previous option. In this case, though, I ended up closing the contract to free the collateral for 13 cents a share, so it was about $13 total. In these two examples, I walked away with $218 combined, but was never assigned shares, which is actually pretty good considering the amount of collateral that I actually had tied up to buy both of these. Now let's go through a real example. This is me. I talk a lot about Shift, as you all know, I like Shift, or ticker symbol SFT. I decide I want to buy more, but I really wanted it $7 a share. So I have two options. I can put in a limit buy order and wait until it executes, or I can sell a cash covered put and make money while my money is waiting to be executed or used. Both of these are great options, but I really love cash covered puts because I can make money while waiting. So let's go through the steps here. I find a contract. It's about 2 months out for 85 cents a share. I create the contract. I sell it, netting $85. I spend that $85 to reinvest into something else. I keep it no matter what. But I do have $700 tied up in collateral. I have not, I haven't spent the money. That $700 is just being held. So if this is on margin, I won't be charged interest unless the money is actually used to buy the shares when assigned. Now, one of the possible outcomes is the stock drops to your strike price. Remember, I wanted to buy the stock at $7, so this is a good thing for me. But wait, actually, my average cost is $6.15 because I had that premium of 85 cents a share. Now, I like Shift. I plan to hold it a long time. I made money while waiting for my price target, and I feel good. I feel like I got a good deal. I believe in the company. I like the stock, so I'm happy. Now, here's another possible outcome. The price for Shift increases and never hits my target, so I never get the shares. It's fine. Contract expires, but I still got my $85, and I've already reinvested that. I get my collateral back. I walk away with the premium. I'm still happy. Didn't get my buy target. Maybe I'm not as happy as if I would have gotten to buy the shares, but still it's a win-win situation. Another option, I want to close my position because I want my collateral sooner. It's, a couple days from my contract ending, and it's super clear to me that shift isn't going to hit my price target. I want my collateral to purchase something else, maybe Coinbase, for example. What I do is buy a matching put to close the position. Remember, I sold a put at $7. I need to buy a put at $7 to close out the position. In this fake example, I buy a put at 12 cents a share, or $12 total. So I still walk away with $73 after considering the $85 I made and subtracting the 12 from it. But I'm able to use my collateral sooner. Now, there might be other reasons to close your position. Maybe you don't want to get assigned. For example, maybe some bad news or press came out, or maybe the fundamentals of the company have changed and you don't want to own the stock anymore. Now, in these situations, you're probably going to take a loss, meaning that you're going to pay more than what you sold the put for. But maybe it saves you money in the long run if the company is headed downhill. But honestly, I only recommend buying cash covered puts on companies you want to own and ones that you will not be upset for getting assigned the shares to. In fact, there are some strategies which you can use to make money once you are assigned using options, which maybe I'll talk about in another video. So I talked a little bit about liquidity. The way I tell if there is decent liquidity is looking at the number of option dates available, as well as the option ranges. For example, the smaller the range between the bid and ask prices generally means that there is better liquidity. So for example, on Asana over here on the left, there's a 20-cent range. It's getting a little iffy for me, where Shift has a 10-cent range. That one I feel a little bit more comfortable with. But both of these don't have the greatest liquidity, in my opinion. One of the reasons I like AMC is that it seems to have massive option liquidity. But I will say the stock has been pressured a lot with the push from Reddit and Wall Street Bets. So it's a bit more volatile than I like. It's still a company I wouldn't mind owning, 100 shares of for anything under $8, maybe even $9. Anyone that gets into cash cover puts, there is risk involved. You need to treat it as if it's a company that you're investing in long term. Make sure you understand the fundamentals. Make sure you like the company. Anyway, I hope this helps you understand the basics of cash covered puts and gives you another strategy to use in your toolbox for investing. And as always, invest safely and hit that like button on the way out. See you next time.